Been a very interesting year, 2024, in the real estate market. A lot of commercial real estate projects have suffered due in large part to the rapid increase in the interest rates and the rapid increase in the rate caps. And we thought maybe we'd get big rate reductions. We got one earlier this fall, and then an indication that the Fed isn't expecting significantly lower rates next year. So today we're going to get out a crystal ball. We have somebody with a crystal ball, Bronson Hill, and we're going to see what's likely or what's possible in 2025. So Bronson, welcome to the Wealthability Show. Good to have you on, and very excited to talk about this really critical topic for coming up on 2025.
Hey, Tom, I'm really excited to be here. Really looking forward to talking with you. And my crystal ball is broken, but I do have some thoughts, and I'd love to share and be able to have a conversation about it. So let's jump in.
All right, I appreciate that. So Bronson, start by just giving us a little of your background and what you do.
Yeah, so I was a well-paid medical sales professional. I did that for 10 years, was in surgery in the OR, working with heart surgeons, enjoyed it. I didn't have control over my time, and that's really, people say they want financial freedom, but really for me, it was about time freedom. And so I learned about real estate, started investing in single family. It didn't really allow me to get to my goals quickly enough. And so I found more about multifamily, larger deals that are 100 units or more, started raising capital for real estate and for other types of business deals. And now 6 years later, raised about 45 million, quit my great corporate job, and I have freedom of time. So it's been great. There's been some challenges on the way, as I'm sure we'll talk about, but it's just been a great ride to learn about helping people with financial freedom.
So your specialty is multifamily?
That's really where we started. We have about 2,500 multifamily units. Really, we've done a fair amount in that space, and we've also done some stuff the last couple of years in cash flowing businesses. Just because that's the thing in real estate where we had cash flow, and it's been harder to find cash flow for people, which really is, I think, the most important thing when someone's looking to quit a job or to retire. It's like, where's the cash flow? How am I going to cover my rent or my house payment or my insurance? And so my book, Fire Yourself, behind me here, I talk a lot about cash flow. And so we shifted to do a little bit more of that. We are getting back into multifamily the last 3 to 6 months. We've been buying quite a bit more, and we're really excited about the prospects for 2025.
Yeah, so let's get into it. Let's talk about 2025. That's why we're here. Sorry to hear your crystal ball's broken. I mean, I totally was expecting it would be in full force, but we'll take whatever you've got, because with the amount of work you do in commercial real estate, particularly multifamily, we would like to hear your thoughts on this. So first of all, what's happening with interest rates? Let's start right there, because we got a 0.5% cut, then we just got a 0.25% cut, but the Fed said not much more is coming. And on top of that, and this is kind of the second part of the question, Fed reduced its interest rates, but mortgage rates actually went up. So first of all, tell us what you think is going on in the interest rate world. And then let's talk about, if you would, what's happening in the mortgage rate world, because it seems to be a different world than the interest rate world.
Yeah, well, it's interesting. They are related. They're not exactly completely correlated. And when the Fed says, "Hey, we're gonna lower rates," and then they say, "But that's probably all we're going to do," what the market hears is, "Oh, that's it. We were expecting a lot more." And so these long-term rates tend to go higher. So it is interesting. Interest rates are very interesting. It doesn't always mean when rates go down, real estate valuations go up. That's kind of what we've seen typically as rates have come down the last 30, 40 years. Valuations have gone up for most real estate, almost all real estate. But there was a time, it's happened multiple times, but in the late 70s, early 80s, when rates were rising very quickly, rates grew substantially and real estate values went up. So sometimes it doesn't necessarily mean that lower or higher rates, are exactly what's going to happen. Now, you naturally would think if the cost of money, interest rates go down, real estate generally goes up. But one of the bigger pictures I like about multifamily real estate in particular, and other forms of real estate, but especially multifamily, is that we know based on studies that we're short between, depending on which study you look at, between 1 and 7 million apartment or housing units in the U.S. So if that's the case, we've really slowed down on building. There's some places where deliveries are coming online, but places such as Dallas, Texas, Charlotte, North Carolina. We're seeing in these markets, discounts to where we were at the peak 2, 3 years ago of pricing. We're seeing discounts of 15 to 30+% in these booming markets that have only continued to grow, where there's population growth, job growth, income growth. So I think that the underlying fundamentals of multifamily are great. And I think that another thing too that you brought up, Tom, is that people have had some real challenges with multifamily, particularly with bridge debt. We had a couple of bridge debt deals we had some real trouble with, and some people have, as investors have either lost money or they haven't cash flowed the way they want. So people are generally more skittish. We had deals several years ago. We were one of 30 plus offers at the table, right? So whenever you're one of 30 plus offers, you're never going to get the best deal. You're never going to, as a buyer, it was really a seller's market. Well, now there are opportunities, and there are things that, again, we have the underlying demand is there. It's just to buy again. I would rather buy at a higher interest rate, and potentially see the rates come down. Of course, the Fed. I think the more we know about the Fed is that they can shift course pretty quickly. When they said, "Oh, we're going to keep rates super low," very quickly within a couple months they decided, "Oh, now we're going to raise rates." So the Fed is very dynamic, and they can kind of say that what they're going to do, and it can change very quickly. And so I like to look at more of the underlying fundamentals of saying, is this a great investment? Is there demand there? Is there growth in this specific market? Because real estate is not just this is what real estate's doing. It's this specific market. Is there growth there? All the growth factors I mentioned. But I think it's a great opportune time now.
Yeah, but I know you're going to be really positive and you're super hyped up because you're a real estate guy. Okay, but my job as the accountant is to actually slow that down a little bit and say, okay, let's look at the fundamentals here, because it's all about the fundamentals. I get that we still have a housing shortage. We still have a housing shortage, like you said, 1 to 7. I've heard 2 to 3, but there is some shortage clearly. That said, so let's look at what's the value of commercial real estate. Actually, it's the value of any business. And that is what you said. It's cash flow. And in real estate, we term that cap rate, right? So what is the cap rate? So cap rate, the way I look at cap rate is, if I were paying cash, what return would I expect on my investment? So when interest rates are low, that I probably expect a lower cap rate. And the reason I expect a lower cap rate is because I can't get more money somewhere else, right? So that means that I can get more money in real estate than I could, say, on a treasury bond or a treasury note. So therefore, I'm going to go to real estate, and and I'm going to pay more for the real estate. There's going to be more demand, right? Supply and demand of the real estate investment. And I'm going to pay more for the real estate, which will lower the cap rate. Okay, that's one thing that affects cap rate. But interest rates obviously affect cap rates, because if I can get, I know people are getting 10 to 18% interest right now. Okay, I'm pretty safe in investments. Okay, well, if I can get 10% on a safe interest rate investment, why would I want to invest in a real estate deal that pays 6% and may have more risk, involved with it, and certainly has more moving parts? And so one of the things that we've seen this year, as you know, is we've seen this disconnect between sellers and buyers, where sellers have been thinking, oh, it's going to come down, therefore I'm going to hold on my price. I'll do a capital call. I'll raise I'll raise money to get an interest rate cap from my lender. And they've kind of been kicking the can down the road. One of my questions for you is, do you see that can continue to be kicked down the road? Or what I think I heard from you is you're starting to see people basically give up and say, hey, it's not going to get that much better. I'm going to have to dump this property. I've seen deals that have just gone under. Okay. Yeah. I've seen deals where the syndicator said, hey, the value's gone. This is gone. We're just going to terminate. And we're either going to give it back to the bank, or we're going to cut a deal with some new investors, which I actually think is baloney. I don't think that's a fair play, frankly, and those people would never get my attention. Okay, that have done that. But what do you see happening tame your enthusiasm just a little bit,
Yeah, yeah,
Bronson.
yeah.
I get
Right.
it, but tame your enthusiasm and tell us, what do you actually see as far as, you said, 15 to 30% discounts, and yet if you look at cap rates, it should be a 50% discount.
Right, right. And to be clear, there has been a period of 2 years where we took a break from buying multifamily. So we have been out. We have recently gotten back in. So let me clarify that. And I will say you're absolutely right. Right now, there are debt deals, debt funds. We have a debt fund. We do. Other people have debt funds that are paying similar to what equity deals were paying a few years ago, right? So that's a much safer position. It cash flows every month. And why would you take a much lower return to do it? So there is definitely a risk premium. It doesn't necessarily make sense, right? So if we're seeing sometimes debt deals are paying 12 to 15% annually, obviously it depends on the deal, depends on how much, all those different factors. But the equity deals, that's similar to kind of equity projections for a few years ago. So there is kind of a disconnect there. I mean, what I would say is, there's the Warren Buffett saying, "Be fearful when others are greedy, and be greedy when others are fearful." I have a good friend. I don't know if you know Mark Moss. Mark Moss is an
Mhm.
economist, a friend
Yep.
of mine. He really believes that in 5 years all real estate's going to be like twice as expensive, and the reason I think that there's some merit to it, I don't know if that's exactly true, but I think that with all the creation of currency, with all of the there's a strong correlation between rents and inflation. There's a chart from Mother Jones from 1960 to now that shows that rent and inflation just kind of goes hand in hand. So the value of single family, people don't realize this, the value of single family home, that's what we think when we think of real estate often. It's related with comps, how much a house sells for across a street or down the block. But with commercial real estate, it's how much income, how much
Right.
cash, as you said, how much cash is coming in. So if rents are substantially, if they do go up, that dramatically increases the value of a property. What you said about cap rates is also true, right? So cap rates, in general, we think they should generally be higher. They're not as high as we would like them to be, but again, for those discounts of 15 to 30%, there is a lot of pain in the market. And you were talking about this disconnect between buyers and sellers. We've been seeing that the last several years. Well, now people have been holding on sometimes for a couple of years. They have to sell, right? They have to sell at a loss. They've got to sell at a loss to investors. We've seen some deals where we bought where they lost $5 million on the deal. The current group that's in there we're buying, right? So I think that I'm looking at multifamily has been a very in favor asset, and now I see it as a very out of favor asset. I will say this as well. It still does not offer the amount of cash flow that you'll see in other types of deals, such as oil and gas or private businesses. You mentioned cap rates. We're seeing mid-sized businesses, I mean, under 30 million that are selling. If you convert it to a cap rate, it would be a 30 to 35 cap rate versus a lot of multifamily real estate, which is a 5 to 7 cap rate. So again, for those listening, that's if you paid in cash, what percentage would your return be per year, right? So we're seeing for cash flow, there are still other things besides multifamily that look really great right now. With that said, I believe right now multifamily is a good long-term investment. I believe it's in, it may not be, again, we don't look at this quarter or necessarily just this year, but in 5 years and 10, down the road, is this going to be a great place to be
Well,
positioned?
yeah, but as we know, real estate, it's all about when you buy it. That's
Sure.
what's critical, is when you buy it and the price you buy it at, and the price you buy it at is directly related to cap rates. Now, here's my question. Right now, what are you seeing interest rates on multifamily?
It depends on the specific project. The ones that we've done, the rates typically, I honestly haven't looked, this week or anything, but they could be around, 6.5, 7.5%. There are
Okay, so
opportunities.
okay, so six and a
Yeah.
half, 7.5%. All
Yeah.
right. That means that your cap rate has to be higher than your interest rate. Otherwise, you have negative leverage, right?
Correct.
Otherwise, you're paying to own the property. You're not getting positive cash flow from the debt. So one of my questions is, what you're doing and what you're seeing other developers do. Are you are you actually putting more equity in and
Mhm.
less debt because of these high interest rates?
Yes, absolutely. Yes, I mean, our partners that we're working with, we work with different partners. One example, yeah, we're instead of, 20% down, which is a more risky position, putting 30, 40, 45% down and actually buying the interest rate down, putting caps on it or buying it down to 4.75 or buying it low enough so that it does cash flow, right? So that requires more equity, and that just generally means lower returns, but it's a safer position. So, I mean, that's what we're seeing more of. Obviously, people are doing all kinds of different things. They're using fixed rate, they're using different things, but you're right. I mean, that negative. cash flow, especially if you're not putting enough down, is very,
So,
you
so,
know, yeah,
so let me, so I got to dig into this.
yeah, yeah,
I'm just an accountant. Okay.
sure. You're a
So
numbers guy.
I'm a numbers guy. So I'm going, you're buying the interest rate down, which means you're paying for that, which means you're paying the same interest rate. I mean, you're not paying a different interest rate. You're just paying it now instead of later. Okay. So that means that you are actually paying that interest. You're just prepaying the interest effectively. That's what happens when you buy down the rate, right? That's what points are. That's what a buy down is. How does that actually make that better? I mean, from the standpoint that, okay, your interest rate, if you look at your real interest rate, not your nominal interest rate, which is what's stated, that 4.75, but your real interest rate, which is the 7% that you just bought down to 4.75, let's say your cap rate's 6% or 5%. How does that make, how does that still work? I still don't, I'm not following
Yeah,
that.
well, the way it works is it does give you, potentially it gives you some cash flow. It also, if you're doing a value add project, and with a high degree of certainty in the next 24 months, you're going to be able to renovate 80% of the units. You're going to be able to see rent increases. But again, this involves having an experienced sponsor or somebody who's vertically integrated who can do in-house construction or property management, knows with again a high degree of certainty that's going to happen. So again, I think projects look different than they did a few years ago. I think between 2010 and 2021, if you owned real estate, if you owned multifamily real estate, you were a genius because you owned it. Now it takes much more of a specific plan of how you're going to actually make it work, how you're going to actually work the project, work the plan that you have, particularly on the value add side. So again, I wouldn't say every single, again, this is a strategy that we're seeing, some success in, but it depends on who the operator, who the group is, that you can manage the cash flow of the project as well as do those value add objectives along the way.
Okay, so it's basically a cash flow management. You're just getting your equity. You're just getting extra. You're prepaying it so that you have the cash flow, so that you're
Correct.
not pressed
Correct.
on that monthly nut that you've
Exactly.
got.
Yeah. And that's how
Okay,
people get in
okay.
trouble. That's how people get in trouble. Yeah, yeah. Is they can't cover the
I,
payment. Yeah.
I get that. Okay, so it doesn't change your interest rate. So interest rates are one aspect of cap rates, but you mentioned the improvements. Um, uh, most syndicators I know, they tend to go after the B minus, C plus properties, and that's they're looking for 80s, 90s construction, and they're because they're tired, right? These properties are tired. They can make some improvements. Like you mentioned, the other aspect of cap rates, though, is risk, right? So it's not just interest rate, but it's risk. And of course, the better the property, the lower the risk because you're going to have people that want to rent it, right? And they're going to pay higher rent. So when are you seeing more syndicators that are trying to move their projects from, say, a class B minus to a class B plus or an A minus or something like that, where they not don't just renovate, but they actually bring up the level of the building from what it has been historically, so they can get a different class of renters.
Yeah, I think that's really a great value add approach where you're trying to, find it, like you said, a building that's tired, or maybe the tenant base is not that great, or the management's just stopped paying attention or really, renovating a place. I think, anytime you can come in and do renovations, it gets, you are raising rents, but it does get people excited to live there. I mean, it's the kind of the broken windows theory, right? One broken window in a neighborhood, it starts to lead to more broken windows. There's a study they did in New York, and so the idea of a property owner coming in and renovating and making a place nicer, I think in general has a very positive effect on the community. And so I think the value add approach in general, I think it is a solid approach. It just really depends on, is it able to be executed, especially coming back to the idea of having safe leverage and really having enough money down. If you put 20% down and you're trying to do this big value add thing, there's always going to be more, especially with bridge debt, always going to be more risk there, right? And I think that we've seen that where instead of, just values always go up in real estate, we've seen values come down. So if that happens, is the deal stress tested well enough so that it can weather that, right? So I think that for a lot of people looking at deals these days, I think it's so important to look at the operator you're working with. What's the leverage that's there? What's the the strategy? And if it doesn't go as planned, what happens if let's say cap rates go down, or or they go up? Let's say there's some valuation issue where now prices decline more. Is there enough value that's been added to this deal, and are we sure enough that that's going to be able to happen? So those are the things I kind of look for when looking at a partner and looking at a multifamily deal.
This reminds me of a couple of years ago. I was on Necker Island, Richard Branson's private
Yeah,
island, and I
that's
actually
awesome.
was fortunate to sit across from him at dinner one night.
Wow.
And I asked him, I said, "So you've gone in and you've completely changed industries, right? You changed the record industry, the music industry. He changed the airline industry. What'd you do?" And he said, "It's not that hard. You look for everything you don't like about the industry and you do the opposite, right?" And so
Yeah,
it sounds like that's what you're talking about. I mean, real estate's just a business. A business
yeah,
is a business. I found it interesting that you decided to look at mid-sized businesses when you're a real estate guy, when really a business is a business, right? Whether it's real estate or some other business, you just have to know the business really well. I mean, it's like I can go in and I can go buy a CPA firm and I know I'm going to make money. I mean, there's no risk to me
yeah.
if I buy a CPA firm. Whereas, you go in and buy real estate, you're going, okay, I know all the factors that I need to understand. What can I do differently than the previous operators did to add value to this? Does that make sense?
Yeah, 100%. No, and that's really it. I mean, I think when it comes to a business, and that's why we like businesses as well, is I think is we're pretty over time we've gone from being multifamily or me being just a multifamily guy to like, well, let's look at some other stuff. What else is out here? And I think that there is a great time to buy multifamily. There's a great time to buy every kind of asset you can think of. It just depends on how much you got to have to pay for it, right? So I think that it depends really what problem. I know you work with a lot of people on tax strategy. If they're trying to solve a tax problem, well, there's investments like oil and gas and other types of things that really help without those issues. So I think that really finding the business or whether it is a multifamily business or it's a private or an e-commerce business like what we're doing, finding businesses that really make sense and trying to do it in a safe way, like you said, where you can reduce risk. So I think one great way to invest is an area that you have an edge, right? So we have an edge in multifamily real estate. We've also got an edge in some business side, especially with partners and making sure that we're doing it correctly. But you want to look and see just for the scenarios that you can put together, what's the likelihood of this going well or not going well? What is the primary risk? I talk about this in Fire Yourself. What is how are you going to make money on this? And what's the, one or two ways that are risks that you may lose money. And if you don't understand that, you haven't looked hard enough because every investment has risk. And so I think that being able to evaluate any investment is very important, and we talk about this in Fire Yourself, where it's putting through a funnel, right? Is this meet your specific goals, whatever problem you're trying to solve? Looking at the team, the operator, the values of them, and all that, and then looking at the specific deal itself. And so I think it really does transfer over, and that's why I say multifamily investing is the gateway drug. A lot of people get started in it as investors, and then they go on to other things, right? Because it's like, oh, I could do this and whatever. It's very understandable once you understand how to evaluate a multifamily deal. You can understand other deals as well.
Interesting. You mentioned Warren Buffett earlier, and I was watching a video of Warren Buffett and his partly partner Charlie Munger that was taped a few years or recorded a few years ago. And one thing he said, he goes, the problem most investors have is that they look at 35 businesses. He goes, you are lucky if you understand three and
Mm,
can find three good businesses in a lifetime. He says you'd be really lucky. And so the idea of this having 35 different businesses doesn't make any sense. So one of the things I'm hearing you say is that, hey, you've gotten really good at multifamily. And the challenge you've had is that people, even the best people, multifamily, and I know some of the best on earth, they haven't, there was nothing to buy this year because people were hanging on. Okay. So let's specifically talk about that industry and look at next year. Okay. First of all, what do you suspect will happen? We're a year from now. We're having this conversation a year from now. Where do you think interest rates are? And where do you think that 2 to 3 million of housing shortage is in a year from now?
Yeah, well, it's a good question. I mean, it's interest rates, anybody's guess. I mean, my guess is it'll be probably about the same of where it is right now. It could be higher or lower, but generally, I think the trend we're going on is we're going to be there. Um, I do think that, more sellers are going to have more pain and they're going to have to sell. And I think it's going to lead to potentially, again, we don't know how much, but again, you have these inflationary factors such as we need more housing. They're creating more currency. These are very inflationary factors that mean the value of things are going to go up, the value, cost of rents are going to go up. And you have deflationary factors such as, interest rates, seller issues, things like this. So where does that actually take place with all this new currency that's been created and all these other things on, that are above real estate that are more macroeconomic? And so, it's hard to say what the timing of that's going to be. I think that's the thing we know over time. All real estate will cost more. We know that generally over time. In 12 months, it's very difficult to make a prediction. If I was going to predict, I would say valuations would be fairly stable. I think that there's inflationary and deflationary forces there. I think that some people are going to have to sell, which is going to drive the cost of buying these existing apartment buildings down. But then there's the inflationary factors such as we need more housing. There's not enough, and in certain markets, that really causes a huge jump in prices. So I think that it's hard to say, over the long run, we are going to see prices go up significantly. Is that going to be in 12 months? I'm not sure. My crystal ball is still broken on the floor, but if I get a new one, I will let you know, Tom.
No, do. So it takes me to another Warren Buffettism, where he
Love
says
Warren Buffett.
one of the keys to investing is don't lose money.
Hmm.
And so that's the buy side, right? That's the buy side. That's making sure that your income is greater than your expenses. Okay, simply put, that you're able to improve the property, et cetera. But there are people that lost the value's gone down so much just in 2023 and 2024. That's not going to recover for years, that
Yeah.
price. Okay. So you're not talking about, oh, it's going to recover in 2025 or 2026. It's going
Right.
to recover in 2030. All right. I mean, that's how much value. I mean, when you lose half the value, it's you can't just so if I go from uh, uh, $200,000 a door to $100,000 a door, if I increase my value, I lost 50%, but I've increased my value by
Double it.
50%. I'm only back up to
Yeah.
$150,000. And so I have to double the rate of my increase compared to my loss as a
Right.
general rule, right? Because you're starting at a higher level, right? It's a percentage of a higher amount. And so given that, um, are you being cautious about your buys? Because what if I mean, yes, you can improve the value, but you're mentioning interest rates not going down. So you bought the interest rate down, so you paid for it basically. Um, but let's say interest rates don't go and they stay at 7%, and you're buying at a 6% cap rate. To me, that's a recipe for disaster.
Right. No, I think you definitely want to play out different scenarios and try to figure out, what do you see happening, and if I think is there any margin of safety? Warren Buffett always talks about a margin of safety. So the margin of safety in some of these deals is the value add component if your debt is stable and you have a certainty that you're going to be able to do the value add component. It gives you some additional safety there because you're increasing rent. Now, our good friend Ken McElroy, both we're a mutual friend, he has lost investor money. We have lost investor money through multifamily. It's happened both, and we have. So I think that on the other hand, it's important to learn and try to figure out, okay, what are the lessons from this? What are the ways that we can kind of make this work? We know we have an asset that long term, and this is the challenge is, if you're able to get fixed debt on something that lasts for 5, 7, 10 years, you're gonna be much safer than somebody who has bridge debt that's 2 years and then you've got to re-up. And so I think the debt structure, that's one lesson that's come to me, has been very, very important. What is your debt structure? Because if you have to sell
Wouldn't you
because
think we would have learned that in 2008?
the problem is that we get into a frenzy and a craze, and then it's harder to, you know, uh, to be when people are being greedy. It's harder for personally to be fearful, and that's Warren Buffett talks about what's the best quality or like character trait when it comes to investing. He says it's your temperament. It's your temperament that's actually the
Right.
best quality. So if I can say everybody's making tons of money, but I'm okay sitting on the sidelines, then that's okay. So we're very selective in what we're doing. Again, we took a 2 year break. I am excited about getting back in for the reasons I mentioned. If it's with safety, with other things, I have other things that I find are stronger cash flow, but I still think multifamily right now has a place in people's portfolio. So with that said, I mean, friends like Ken, I mean, they're saying, hey, we are looking, we're doing a lot less deals, we're looking at many more and doing far fewer. But there still is a demand. I do think also another factor is that construction in the last couple of years has really slowed down. The new starts has slowed down significantly for new builds. So that leads to not an increase of inventory as population is increasing. And it's not just increasing across the nation, which it is, but in certain air markets, right? The Dallas Fort Worth market, the Charlotte market, there's certain markets that are booming, right? And the population is booming. So they have to live somewhere.
Yeah. Final question. Let's address
Yeah.
that. So Trump campaigned on deporting people and not having this big influx of immigrants, which is certainly some of what has pushed up the housing market is the immigrants.
Sure.
Because as a nation, we're not having more children. We're having fewer children, not more children. And so the increases has really been coming from immigration. What effect on housing, certainly rental prices, do you think if he stops the influx of the border, first of all, and then he starts pushing people out, and you've got, 1 million, 2 million, 3 million people actually going back to where they came from where they originated. How do you think that will affect the demand and the pricing in the housing market?
Yeah, that's a great point, Tom. Obviously, it would have a negative effect for sure because obviously people would be no longer in a place of demand, and there are certain markets more acutely than others. I personally think there's a lot of talk around this. I think to actually implement it with millions of people would be very difficult. I think it might be a years long process to do. I think that if you look at, I was actually reading an article about this, about in a given year, something like a couple 100,000 people are deported, or the last couple of years. I think Trump at the biggest year he did maybe 400,000. So this is already happening anyway. So if you go from 400,000 or 200,000 up to 1 million, it does have some impact, particularly in specific markets such as, I live in Los Angeles area. That's a big area. Maybe Florida, maybe New York. There's certain areas that
Well,
there
and
are.
those areas have depended largely on being sanctuary
Yeah,
cities, right? And so the immigrants come there. It's basically a loophole in immigration. But you mentioned that the rising population. But if you stop the border, you don't have a rising population.
right, right. You're right. Yeah. So that is definitely a concern, and that's something to see to do the dynamics of the deal work. At current valuations, and even if rents do go down, you want to stress test it different ways. And again, this is one factor of many that are this is obviously something that would cause a devaluation or the prices to come down, but the other ones that cause the prices to go up. So I think it is definitely a consideration, something to consider, and it is a huge factor because. If your population, if you take 1 million, 2 million, 3 million, 5 million people out of the U.S., it does have an impact on
You,
housing.
you no
Absolutely,
longer have a housing shortage.
that's true. Yeah,
No, seriously, by definition, you no longer have a housing shortage. If you have 2 to 3 million housing shortage and you lose 2 to 3 million people, you no longer have a housing shortage. So,
yeah,
the point of this discussion, everyone, is that if you really want to reduce your risk, you've got to increase your education. And you listen to people like Bronson or Ken McElroy or my friends at Thrive in Austin, but you listen to really good Brad Sumrock, really good real estate investors who have been successful and maybe less unsuccessful is a way to put it over the last couple of years because I don't think anybody predicted the Fed would raise rates that fast
right.
and that hard. But at the same time, it's this education, and that's why we do the Wealthability Show. That's why you get education at Wealthability from our tax-free wealth advisors. That's why education is so important. That's why I think, Bronson, what you're doing in your podcast, in your books is important. So tell us where we see your book. Where else can we get more information about what Bronson Hill is doing?
Yeah, thanks, Tom. Really joy to be here. Always been a big fan. Love your tax-free wealth strategies. Yeah, I'm just so excited about what you're doing. For your audience, love to give a free gift. A lot of people we talk about inflation. They say it's 2.7%. I think it's substantially higher. And instead of being hurt by that at the pump or at the grocery store, there's a way you can be on the other side of the equation where you use it to your advantage. So I have a 40-page guide called How to Use Inflation to Your Advantage. Talks about using real estate, using debt, using precious metals, some unique strategies people haven't heard of. You can text the word inflation to 33777. It's the word inflation to 33777. That'll get you the guide and it'll kind of get you in touch with what we're doing and hear about our upcoming deals if people are interested in being in touch.
Awesome. Thank you, Bronson. Thank you, everyone, for listening and watching the Wealth Ability Show. This is where we get great commentators like Bronson Hill on our show so that you can actually have less risk while you're making way more money and paying way less tax. We'll see you later. Thanks very much.
This podcast is a presentation of Rich Dad Media Network.